Good evening, ladies and gentlemen. Today we have Siddharth Bothra with us. He manages one of the most popular funds in the large cap category, M Focus 25. Apart from that, he manages a couple of other funds as well. So Siddharth has been associated with Motilal Oswal for a while now. He's close to 13 years of experience in research and investments. He was one of the lead analysts at Motilal Oswal Institutional Equities before he started to manage funds at MOAMC. He's got an MBA degree from ISB Hyderabad and has been managing a couple of other funds like Motilal Oswal Equity Hybrid Fund and Motilal Oswal Multi-Asset Fund, apart from the F25 fund. So Siddharth, welcome to PMS AIF World. So typically, let me give a little background of us to the audience. So if you've been following us, we are all for informed investments, and on our YouTube channel, you will find a lot of videos with a lot of interesting fund managers, their take on the market, what they have been looking at, what they're up to. I urge listeners to visit our webpage also. So Siddharth, I will hand over the floor to you. Before that, let me just give you a little bit of flavor. So we just did a poll right now. Large cap investments form what part of my portfolio? 27% of the respondents say that 75 to 100% of their portfolio is large cap, and 41% say more than 50%. That is in the 50% to 75% bracket.
Sure.
While 33%, that is 1/3, say that it's between 25 to 50%. So you have a huge, responsibility today. Let me put that clear to you. A lot of investors have majority of their portfolios in large cap.
Right.
Probably because large cap has done so well in the last few months and the last few years that they, seem more, in the portfolio. So over to you. We will discuss a lot of interesting things today. I urge listeners to please, interact with us through the chat window and through the polls we have. Over to you, Siddharth, now.
Yeah. Thank you. And good evening, friends. And thanks a lot for joining in for this webinar and, sharing your time with us. So, as Sankalp mentioned, what I'll try and do is I'll quickly take you through, firstly, about our fund in the sense as to how we manage the fund, then, why we believe F25 is one of the most unique focused large cap fund, and a little bit on our performance side, and then, we could probably open it up for questions. So I'll just start my presentation. Just give me a moment here. Right. So, I just wanted to kind of start with as to one of the first things, why, most of the Motilal Oswal funds are different, and, which is also the case for Motilal Oswal Focused 25 fund, is that we have a very well articulated investment philosophy. Most of the investors who, are looking for, a similar kind of investment style. This is one of the funds where you have a well articulated strategy, and people are aware as to how their money would be managed. So we acronym our investment philosophy as QGLP for simplicity. It is actually nothing but, very simply put, where the Q stands for both the quality of management and the business, and the growth is essentially, which is growth for earnings, and more importantly, we are just not looking for fleeting growth. We are looking for longevated growth, and we are trying to buy these qualities at a reasonable price. So why it's like QGLP and not like starting from some other letter, because we believe that our subset comprises, once you pass the quality test, and that makes all the difference. I think the subsequent slides will make it much more simpler. So I think one of the questions have been that since you all have this stated philosophy, how does that help you? So I think if you look at this Venn diagram here, it actually just simply tells you the shaded area or the numbered Venn diagram parts, tells you that this is the segment that we focus on. So firstly, how the investment philosophy helps us is that while there are almost like close to 1800 2000 listed stocks across the exchanges, what it does for us is that it narrows down the entire universe that we are looking to a much smaller number, which is less than 10% of the listed equities. And even within them, we are able to slot it in each of one of these Venn diagrams and know exactly uh, you know where how should be the positioning, and what are the typical slots. That gives us a lot of sense about the companies in the first place. So let me try and explain you this particular part, which we have shaded out as to what we call the focus area for us. And even within this focus area, we have finer we actually try and even cut it further there. So if you look at it, the five the blocks that we saw in the past slide. So first is obviously where we have all the letters, which is QGLP, which is we have quality, growth, longevity, and price. And then we have two other ones where for a momentary time, say a year or 2 year, the growth is not there, like the case we saw, say maybe if you go a couple of years back, then Maruti, Eicher, or some of the stocks where after a very strong growth phase, for near term the growth was not there. So we call it the patient zone. And then we have where quality, growth, longevity is there, but optically it seems that the price is high. That is because when you are a very high growth company, when you look at in a traditional valuation matrix of what's the P next year, or what's the price to book, sometimes it appears high. And in fact, if you look at the past 20-25 year history, or even globally, whenever there's a young growth company, or you come across a very tailwinded sector and a company which is winning in that sector, for a very long period of time, when the company continues to do well, the valuations look expensive. So we just don't knock off companies just because optically valuations are high. So we try and see if there is any insights to be gained there. So this is what we call our wealth creation zone. Our entire investment focus is largely around this. And just to take you back, so even within these five buckets, what we try and ignore are these two buckets. The first one, where longevity is missing, that is where you have the quality, you have growth, you have price, but longevity is missing. So we call these value traps, because essentially these are companies where either technology wise they are challenged, there is a new technology which is disrupting the business, or these are businesses where there is some regulatory issue, or some such major obstacle, because of which market participants are not able to take a view beyond something, beyond some years. And as you must be aware, bulk of the value for most of the companies when we try and do valuation comes from the terminal value. So essentially here the issue becomes that you're not aware of the terminal value. And then this is something which is a pure, which are definite, ignore, or a definite X for us, which is the danger zone, which is where quality is missing. So this is how our philosophy helps us in, trying to, just think about the entire universe and our investment stocks in a much simpler way. So now coming to, Motilal Oswal Focused 25. So I'll first focus on why large caps, why focus fund, and then why Motilal Oswal Focused 25, or F25 as we call it, is one of the most unique funds. So firstly, I was very glad to hear that, a large portion of the attendees mentioned that, they are predominantly invested in large caps. So let me first just, talk on that point a bit. I think one key thing which gets missed sometimes is that large caps today are very different from the way they were say 2 years back, before the SEBI reclassification. Because before the SEBI reclassification, typically a large cap fund would be one where you have to put only 100% in the top 100 stocks. So that made it very restrictive, and the dynamism was missing in large caps to a large extent. But post this reclassification, any large cap can buy up to 20% across any a market cap across all market cap. Whereas, I'll come to that point, whereas, a focused large cap, because of the category it is in, only needs to be 65% in the top 100. So, these are funds which are a lot more dynamic today and has the advantages of a large cap. So that's why you see so many investors looking more and more at large caps. So I'll come to some of the reasons why large caps today make more sense. The first is it gives you relative stability. A large cap stocks typically has longer history compared to the broader market. It's been most of these companies are well tested across cycles, and the perseverance or the so-called the strengths of the company is much more here. The other is the resilience. Typically, they have larger balance sheet because they have a proven history. For them, it's easier to approach the markets or raise capital, even on the debt side. The third is quality of management. Typically, for a very large cap company, you will see that you have the key people in place for different functions. The quality of board is more in a way. The quality of board is very different from, say, a smaller company, because you have a larger involvement of independent directors. Also, within this. This is a board which has seen over a period of time. So these are some of the advantages of being on a large cap. Now, why a focus portfolio? So I think it's very simple that at any point of time you will have 5, 10, or 15 great ideas. The moment you go to the 20th or the 30th idea, you will not be as bullish as you are in the top idea. So if you find one company which you think you are very, very positive on, what you would want to do is give it maximum weight. So a focused investing, typically you will see the top 5 funds account for more than 40%, the top 10 accounts for more than 70% of the fund, because you are allocating your maximum weight to where your conviction is highest. So this is nothing but a simple maths that if I were to do a similar thing, that is allocate high proportion to where I think the returns or my optimism is more, the likely return will be much more, versus if I were to spread everything across different funds, then the likely return will be much lesser. And this is where focused funds have an advantage. So on that point, you could argue that given that you only have 20-30 stocks, does that make it a bit more risky? To that question, I think there's enough academic research which has shown that the unsystematic risk, which is what we try and diversify by having more stocks or across industries, typically anywhere between 20-25, this risk is completely diversified. Anything beyond that actually leads to increase in risk. So that is one point, that not only are you getting the advantage of a focused and a concentrated fund, but it doesn't add any risk to your portfolio as such. So now coming to why we think F25 is one of the most unique fund. The first point I would say is that it's focused and concentrated. Some of the points we just spoke about. So let me take you through some data that, if you look at the entire universe, like of the large caps as such, typically the range is from anywhere upwards of 40 to almost like 70 stocks. Whereas, we typically range between 20 to 24 stocks. So, this is a fund which is, fairly focused and concentrated. And we believe this is the way to create long-term wealth. That is, you have fewer stocks where, you are able to kind of focus more on, do more in-depth work, and, put your maximum weight where your conviction lies, because there's no point in, say, being very bullish on a sector or very bullish on a stock, and then finding that, it's a 2% or a 3% position in someone's fund. The second point is that it's a pure active and benchmark agnostic fund. So what I mean here is that, if you look at many of the funds as such, they are typically almost like quasi, index, because, they're almost like just 20-25% away from index. When you look at the Motilal Oswal Focused Fund, we are almost like 50%, 58% active investing. That is, we are 58% away from index in terms of weight. What this allows us is that, this allows us to be a completely, or this is a result, I would say, of being a completely bottom-up driven research, bottom-up driven investment house. So we don't invest with a eye on index. We invest where we think it's making more sense. So that's one advantage we have. I'll give you some of the reasons how it benefits us. So if you look in the last 2 years, for a long time we used to have insurance as almost 15 to 18% of our weightage, whereas there was no single insurance company in the index till HDFC Life and SBI Life got in. So this is only possible if you are a benchmark agnostic and a pure active fund. And I think that was one of the reasons why we could have like almost 12% alpha in the last financial year. The third is that we have a unique investment universe. This is a point I wanted to talk about because this relates to some of the discussion points we just had recently. I think the key point here is, let me just shift the slides quickly. So when you look at the investment universe for a focused fund, I mentioned to you that pure large cap needs to be 80% in top 100 all the time, and the flexibility they have is only for 20%, whereas focused needs to be only 65%. Why is this relevant? So we did an optimization study between the mid cap index and the large cap index, and tried to find that what is the mix where I'm able to optimize my Sharpe ratio. A Sharpe ratio is nothing but a ratio which indicates where the risk reward is ideal. So typically, this research shows that the ideal mix is somewhere around 75-25. That is, the range is from 70 to 75 large cap and 20 to 25 mid cap. So this is the range at which, if an investor were to invest on a long-term basis, the risk reward would be most favorable. Rewards better because, you have a good mix of 20-25% of mid caps, where you are able to kind of capture many of the new emerging stories, and that adds some boost to your returns. And on the risk side, because predominantly it remains the large cap focused fund, so in the event of any major disruption or otherwise also, the fund has a lot of stability which large caps brings in. So this is a mix that this fund, which is the focus fund, is able to achieve, whereas many of the pure traditional large cap funds would still not be able to achieve this mix. So that's why I think this is one of the key positives of the Focus 25 fund. So I would now come to our portfolio and as to what's our positioning. So our positioning for the fund right post COVID has been that we want a right blend between being conservative and being aggressive. So our predominant focus has been to try and be in essential goods, essential services, and at the same time having enough exposure towards economic proxies, where I mean both discretionary plays as well as companies which will benefit as and when the economy recovers and starts growing faster. So that's the ideal mix that we have been looking at, and we believe that as we move ahead, we will probably have more and more exposure here between discretionaries and economic proxies. So what this does is that it provides this fund with a I think a fairly decent balance between being conservative and aggressive for long-term investors to play through both the major fear or the major downturn we saw in say March, April, versus some kind of I'm not sure whether we can use the word euphoria, but definitely some excesses that we are seeing today. So that's how our positioning for the fund has been. And let me just take you through our top holdings. So if you look at our top holdings today, some of the banks and NBFCs are our top holdings. Both HDFC and HDFC Bank and HDFC are almost 10% weights. We have Kotak, which is close to 10. Then we have the two tech companies, Tata Tech, Infi. Some of the other large holdings for us are Procter and Gamble Health, PI Industries, Container Corp, and so on. So that's broadly how some of our top holdings look like. Uh, that is one, and then if I were to further come down on the performance side, so this fund has now been almost like 7 years plus, and across all longer term time frames, the fund has done reasonably well, and the performance as such has been fairly decent across these time frames. So, what I did is I just put the value research screenshot as of yesterday. So if you look on a both 7 years since inception or on a 5-year basis, we would be amongst the top 5 funds. Even on a 1 year, we would be in the top 10, or on the YTD, we would be in the top, 5-6 funds. Even on a 3-year, we are at Q1 quartile 1. So those have been the kind of a performance that this fund has had. So, I would just like to quickly summarize on firstly YF25, and then go probably a bit deeper on some of the stocks and how our positioning is for the current market. So first, let me just quickly summarize. So F25 we think is unique. First, because it's a focused and concentrated fund. The second point being that it's a pure active and benchmark agnostic fund. The third point being that it's got a very unique investment universe. Now, coming to our portfolio size, this is broadly how our portfolio looks like. So let me talk about how in the past we have had some big wins. So if you look, we were one of the early investors in Abort, and Abort was one stock which has given us one of the highest returns in alpha. Similarly, I think some of the stocks which have in the recent time done very well for us is Avenue Supermart, whether you look at say a PI or a Procter & Gamble Health. So what we did is, our fund, instead of getting into many of the consumer names, we invested much more in what we call the so-called consumer pharma companies, where say the one example would be Procter & Gamble Health, where essentially all their products are more like over-the-counter or the OTC kind of products, and they just have 4-5 large brands, and they most of them are market leaders in their respective space. So they have all the characteristics which are very similar to a consumer company. So this being one, even Abort to a large extent, again has the advantage of like the top 20 brands of it accounts for almost 65-70% of its ex insulin sales. So that's how these two have been different. Now going forward, where we think we should focus on is that if you look at in the past, last say 2-3 years, the market had been very narrow between some consumer companies, some financials, and so on. I think fortunately what we are seeing is say in the last few months, or I would say even for the last 1 year, the market is increasingly becoming more and more broad-based. So this is where I just wanted to focus on one point that many market participants today may be having in their mind. That is that the market has run up so much. Optically, the index valuations looks expensive. So how should one look at the market? So the reason I have this, all the holdings here in front of me is because I just wanted to focus on things like, some of the things here, which is whether when you look at the so-called capital goods or technology plays like say an ABB, or logistics company like Mahindra Logistics, Concord, or cement companies, or, even, some of the other discretionary plays. So these are segments, which has long been ignored in a way by market, or the point being that there are many sectors, where you still find good attractive bets, where market has not priced them the way they have for some of the stocks which have been market fancy in the last few years. So end of the day, what we are trying to do is try and build a portfolio of say around 10-15 company, in the core ones, and say a portfolio 20-25 stocks. And I think even today, there are enough good opportunities to build a portfolio of around 20-25 stocks. And hence, the focus on market should not be so much. I'm not trying to say that this market, the way it has been going up, is something which is sustainable. But what I'm saying is anyone with a long-term perspective will still, hopefully, if they're investing today, will probably looking at attractive returns, because the market broadening is one opportunity which at least we think is something that investors can focus on. So that's some of the things on our portfolio side. So Sankalp, with that, I would want to conclude on my initial thoughts on the fund as well as our stocks, and happy to kind of take questions or answer to any of the questions that you all may have.
Right. So that was a very detailed take on your fund. Thank you for that. So let me just tell you another thing. We just ran this poll. We asked what kind of is there a possibility of alpha creation still left in large cap funds in India?
Right.
So 80% of the participants believe there is.
Okay.
So we've got some responsibility representing the mutual fund community.
Yeah.
So the first question, and this is a question that a lot of my clients and a lot of my family members have also asked me often. So large cap typically has this disadvantages of being, I'm calling it a disadvantage for lack of better word, of being slightly more expensive.
Sorry.
So large caps typically are slightly more expensive in terms of valuations. Common trend. I mean, there can be various reasons to it, but yeah, on the common parameters, they tend to be more expensive. And the other thing that I have often heard is that large caps typically don't represent the sunrise sectors. Okay, so like America has the FANG companies. The second or the modern day businesses are often in India typically underrepresented by the large cap companies. To take an example, Bajaj Finance was a small cap back in the days, and then the entire consumer financing in India took off, and for a very long time Bajaj Finance was still a mid cap company. Only since 2015-16 it became a huge company. So what's your take on these expensive and newer opportunities or second gen opportunities in large caps? So I would personally want you to spend more time on finding those sunrise sectors in large caps.
Sure.
So up to you.
Yeah. So Sankalp, I think the first point you mentioned about large caps being more expensive, I think the way one should look at it is that you try and find a sub-segment of companies which you find attractive, which have some characteristics that you're looking for. So, whether it be leadership, whether it be in terms of, the dominance that they may be having, the competitive advantage they may be having, the pricing power, and then, obviously, the returns these companies are making, your return outlook, and so on. So I think once you create a sub-segment of that, then it really doesn't matter whether it's a large cap or a mid cap. We are completely agnostic to that, and as you know, our fund has the enough option to buy any of these companies. And when you look at it that way, then I think really there is no major valuation difference. In fact, I would argue that many of the so-called mid-cap or are actually more expensive, because typically they will always be more expensive because if they are relatively of a smaller size, market believes that the growth run rate they could be higher, or the high growth phase for them could be much more. So market typically prices them even more. So the valuation arbitrage between like to like equally attractive companies between large and mid, it's not. I would not say that large caps are expensive and mid. So I think that I have not found. I have actually found that most of the companies which have the characteristics that I look for are today trading more or less at similar valuations. So such a arbitrage is not there. So that's on your point one. So
Right, we take it. Right. So
okay,
it would appear optically
yes,
expensive, or it might not be, is what you're
yeah,
kind of guessing.
absolutely. So
Perfect.
the
Now on the second
second,
point, please. Yeah.
yeah, on your second point about you not having emerging plays, or you're not getting opportunities of finding sunrise sectors in large cap. I would again disagree there, because if you let's go back and look at what were the sunrise sectors in the last few years. I think one of the biggest sunrise sectors, or I'm not sure whether you can call it sunrise sector, but also sector which just got listed in exchanges, because before that you were not able to invest in them in the first place. So that was life insurance and general insurance. So all these companies, even at the price at which they got listed, were all qualifying as large caps only, whether it be HDFC Life, whether it be ICICI Lombard or SBI Life. So, even within large cap, you have so many sunrise sectors, and, so many sectors, which are doing well. Even when you look at some of the AMCs and all, they are typically, even at the listing price, or very, they were almost close to being large cap, couple of them. So, that's one point one. The other point I'm mentioning here within that is that if you look at some other sectors also, like let's take the case of retail. Again, you could say that the first really large company that we could buy on the pure value retail kind of a segment, which is Avenue. Now, Avenue, even at the point of listing, the first day itself, thereon, it was almost close to being a large cap. So I think it's in large caps you find similar opportunities. I think where you may be right is that there are some sectors which are, or industries which are relatively small. Like say, let's take the case of the sector that Page represents, or let's take the case of sector which Astral represents. So they are very dominant and market leaders in their respective segments or sub segments. But you're right that those industries are small, so those companies become mid cap. So I think it's on the second point, it's a mixed bag. And given that now most large caps have flexibility of 20%, or at least F25 have flexibility to almost as much as 35%, we are able to participate in most of these opportunities.
Right. So that's a very, very valid point,
Right.
that although you might be able to, you might be able to accommodate most of the sectors that are, newly listed,
Sure.
and valuations is again a thing of across all sectors. So mid cap stock can also be very expensive, and a large cap stock can also be very cheap. So I take this question, as a very, very insightful answer. Okay, so now the next question is something that might put you in a fix, but I have to ask this.
Yeah.
So we typically are a platform that is, we have a lot of HNI and ultra HNIs coming on our platform, and for them, often the preferred route is a PMS.
Right.
So thank you, Manoj, for this question. So he has actually asked value strategy PMS or most focused 25. So I want to generalize this question a bit.
Right.
Okay. Not restricted to these two strategies, but how do you see mutual funds as a platform for the HNI, ultra HNI today? How relevant is it, and what does the fund offer? Like in a PMS you can have performance fee kind of things. It is customized and things like that. And in a mutual fund we've always spoken of things like a pool concept, inflows, outflows, so many things. So how do you look at this?
Yeah, no, that's
Over
a
to you.
that's a very good question. Let me try and give you a background on this question. So if you look at our house at Motilal Oswal, we have been managing outside money actually from 2003, but it was done under the PMS platform. So our chairman, Mr. Ramdev Agarwal, took almost like I think till 2012, we were only managing money for PMS, and not going on the retail side, because we believe that our style of investing, firstly it evolved across this entire range, and also which was very different from what was being practiced in the normal mutual fund industry, where you had 40-50 stocks, and where the concept of buy and hold or some of these things were not there. And the reason we decided to get into active mutual fund, which we did, this is actually F25 is the first active mutual fund launched by our AMC. was because we felt that we wanted to bring the advantages of a PMS that we had been running for almost 10 years till then, on a much broader spectrum, and allow investors to participate in that, because PMS in a way has its own restrictions in terms of what is the minimum size, and some tax inefficiencies, and there are other issues there. So we felt that this could be a platform where we could offer exactly what the reason we launched it is we thought we will do here something which we've exactly been doing for the last decade, and that we have proven on the PMS side, and we'll do it at a cost of a mutual fund. So I think from that perspective, actually, our mutual fund is very, very unique, because we do almost the same kind of investing that we have been doing for a very long time and under our PMS banner, and we are doing it at a cost of a mutual fund. So I think both cost-wise, the fact that it has the advantage that you can even invest at the lowest amount of money here, and it doesn't have any of the tax inefficiencies. So I think these are some of the big advantages that mutual fund has, and the unique offering that we are able to offer in our funds. Having said that, I think there are some things where mutual fund cannot do what a PMS does. One is that under the SEBI rules, the maximum weight till which I can buy a stock in a mutual fund is up to 10% or less than 10%, to be precise. Whereas in a PMS, that number could be much higher. So this is, I think, the one only difference which is still remaining, where mutual fund could have a disadvantage if you believe that, potentially if you come across some great idea where you would want to put a lot more weight, then, mutual fund at least can't buy. On a passive breach, we can, we buy till 9 and then the weight becomes 12, 13. Then as per SEBI rules, we are not forced to sell, but we are not able to buy. So that is one, so-called difference which is there between mutual fund and PMS. I would not call it like a disadvantage for mutual fund, because, as a risk mitigation strategy, our compliance has a rule for mutual funds wherein, we typically don't want to have exposure of more than 10% in a stock. So from that perspective, there's really no difference between mutual fund and PMS in the way you run it, and more for us, where we try and have the same strategy on running the fund across both platforms.
Right. Thank you. That was very detailed. I hope, Manoj, your question is answered. So something that we've often heard is, again, in the markets, you have to stay put, stay patient. If 2020 is a testament to anything of that, we saw a crash that happened in a couple of weeks. But since then, Indian markets, global markets have never looked back. So now, if you could call it liquidity, you could call it whatever. But the fact of the matter is that we are at 13,700, 500 levels today from 7,500. So what this shows is that, there is no timing the market, but we have, that aspect has been amply covered. So, you've been managing this fund for close to 5 to 6 years. You've been an analyst for 13 years. I feel that this rally was something different. This crash was something different. What is your take as a mutual fund manager? Because mutual funds are one of the most prone to the effects of flows and inflows. Right. So what do you do then? Because if you must have learned your lessons managing the fund, netting against inflows and outflows. How did you keep calm in a crashing market? How did you make money in the rising market? So if you could share some bit of it, I know the master never shares his tricks, but if you could give us some insight as to how you made this journey, I think that will be very interesting for us to hear.
Yeah, absolutely. So I think, one of the things is, I think right when, even in March, April, we have had many seminars and, many discussions across different platforms, where we always maintain that, there are different kinds of correction. And, especially when you have an event-driven correction, which was the case in March, April, where there was an externality which led to a sharp correction. Typically, those are corrections where, if you buy in, then they are like great opportunities. Like if you look back in market correction histories, then corrections can be divided into different times. So there are some different types. So like there are some corrections which happen because of the overheating of industries or overheating of economy. So they take longer time to come back because it goes through its own correction phase of 2-3 years. But an event-driven correction, typically the correction is very sharp and comes back. So that extent, we were able to spot that difference very early, so it helped us. The second was that we, as a house, have a stand that we don't take cash calls. We believe that investors have given us money to invest in markets, and their risk mitigation and their exposure, on which sector or which assets to put. This is something that the investor or the advisor that he's looking at, they do. So we didn't do the mistakes that many others did, where they started taking cash calls or they started speculating on investors' money on behalf of what should be the exposure in equities and so on. So we never do that. So had one tried that, then that would have been a missed opportunity. So those are the two points that I can mention as to how we navigated the last 1 year, now almost like 9 months now. And so I think the other is obviously the point that we are more like a buy and hold investor, so that's been an advantage. Now going ahead, I think if at all anything that we can take away from what happened in this last 9 months is that not think too much of markets, and definitely not try and time the markets. So I would be like very fair that unless, just like other investors today, even the way markets is moving up almost every day makes even investors like us also a bit nervous, because just like the March, April, when it was falling like that was not sustainable. Even market going up the way it is in the last 1 month is not a sustainable thing. So with that as the caveat, I would still say that end of the day, what is a fund trying to do? A fund is trying to invest in 15-20 quality stocks where they can see meaningful returns, which is like say 2 times a bit more than a risk-free rate. So I think when I look at the markets today, I still feel that there are enough opportunities where one could build a portfolio around these stocks if one has a 2-3 year or a slight or a longer term perspective. So from that side, I would not say that market participants should be unduly worried or focus too much on market. I think the focus should be stock wise, focus should be on a fund wise, as what is the philosophy they are doing, what are the kind of stocks they are holding, and have a slightly longer term perspective. That would be my thoughts on the question about the market today and so on.
So you say cash calls worked in your favor this time, but if you, if your prophecy comes to its course that the market might seem overheated, the cash call might be a little, no cash call might be a little, damaging also. But with that, I think over time that is taken care of. So
I would just want to comment one point here. So it's not a thing about your call going right or wrong. It's a thing about as a philosophy. You're not taking that call because it is not my mandate to take cash calls on investors' money. I'm not there to speculate on investors' money. They are the ones who decide how much. So think about an investor who thinks that he's invested in equities to this proportion of his overall assets. And then you find a fund manager who's like sitting on cash because he's double guessing on what the investor should do. So it's more a philosophy thing rather than a right or wrong thing. And let me also make one more point here that hypothetically it seems that if market falls just before that, if you were holding cash or so on, you save money for investors, but it doesn't happen because you remember the old joke that economists are able to predict 10 out of the last 2 bear markets or the 2 recessions. So what I'm trying to say is anyone who attempts to do that typically takes that call so many times that the cost he incurs on your behalf is way more than what he would potentially save even if he gets it right once. So those are my thoughts on market timing and cash calls.
Right. So that's very interesting. Thank you for that, addendum there. I think that helps. So, we've seen a lot of things happen, being said around India, inflows in India. So why I'm trying to talk a lot about inflows is, pardon me, because people feel that there's a liquidity flush rally, and kind of you also resonate with the fact that, I mean, we are in a market space which might be a little overheated. So, do you think that this is just liquidity from the foreign guys that is doing this? Because November was a month where, for the first time, I think FIIs bought more than 50,000 crores. DIIs continued to sell. For the first time, LIC's equity, portfolio value touched like $88 billion, which is like one of the lifetime highs. So we have to agree that you know the stock market is cheering Christmas before it has come. So, what is your view on that? Is it just liquidity, or them? I mean, I am of the view that there has to be something else also. At the end of the day, these are businesses. People are optimistic. Even let's say liquidity was to be there, an FII sitting somewhere in Tokyo, Japan, has a lot of emerging countries to go to. There is Brazil, there is Russia, there is China. China might be suffering from some, malaise kind of a. But do you think liquidity can be the only factor? Because you deal with inflows, outflows, you understand inflows, outflows of investors. So what is your take on that?
Yeah, so it's a very relevant question and a difficult question to answer. So, firstly, if you look, what you're saying is right. The FI flows have been phenomenal in the near short term, and that is definitely you fueled some part of this rally. But also, I think if you were to check that while MFs may have seen redemptions as a overall as an industry, I think the retail investors coming directly to the market has also contributed significantly to the markets moving up. I think that number itself, I would think, be almost similar to the kind of FIs flows we have seen in recent times. So I think that thing is something which is not appreciated much. So you could argue both ways that retail money coming in is a sign of, like, in this manner, is a sign of being cautious. You could also, when you take longer term view, see it as that, in India, the penetration of equities, or, people buying equities, is such a small percentage that, this number could continue to move up. So, I think those are the two factors. I think liquidity has definitely played a role, in fueling the kind of a move that we have seen. And it's very difficult to predict as to why liquidity comes in or why it goes out. Like, but if you were to just think about it, when you go think on a longer term basis, I think India does offer a lot of advantages, and there are very few economies on the emerging economy side where these advantages can be got. And I think the one point that you mentioned, which is a China angle, I think that point is something which is probably not appreciated enough. You've already had some of the instances where there have been the US pensions, or the US government owned or so-called funds have had some provision on whether what kind of stocks they can invest in China and so on. And this entire US-China angle has also led to some of the flows probably moving more towards the ex-China countries. So I think there's several factors here, including the point, the very fundamental point that India looks attractive. I think the earnings growth visibility is increasing. I would believe those would be some of the reasons which would be predominant in for people responsible for these allocation to decide on why India.
Right. So I'm glad you mentioned China. So everybody's talking of a China plus one strategy, and I was just going through your stock portfolio.
Yes.
I think one of the most exciting industries that people mention with China plus one is chemicals.
Right.
Chemical, steel probably, but India is not too good at steel, so chemicals.
Yes.
So one would tend to notice that it is underrepresented in your portfolio. I think you only have PI.
Yes.
So, are you not as bullish on this sector, or are you looking at the China plus one play with a different kind of a angle?
No, so I'm actually, I'm a firm believer there and bullish on it, and hence, we have a fairly decent exposure in PI. We recently took some profit. Otherwise, our weightage here was almost like 6-7%. So I think this is one company which we think is one of the biggest beneficiary, and we have a fair representation there, a fairly decent weight there. I would also say that the another company that we have, which is Dr. Reddy, they also have some portions of the business which would benefit from the same. So between these two, I think one being a pure, as you said, the agrochemical company and a global agrochemical leader, the other being a pharma company. I think between these two, we have a fair representation of companies which would potentially benefit from this China plus one kind of a theme. Having said that, why we don't have many more exposure here is because these themes. When we look at investing, we don't do top-down investing, and we are very bottom-up focused. So when we look at companies which could potentially be beneficiaries here, what we try and see is, does the companies have moats? Are these company where I can look at a 5-year, 10-year or plus visibility? So if the only thing driving many of these companies is what is happening now with China, bear in mind that some of these things could change also in a couple of years. So what do you do with companies which have only this as the reason which you find exciting? So we are not trying to get into such place.
Right. So again, very valid answer. So we will probably take the last couple of questions. Actually, I'll ask you the questions together. So one is that we understand mutual fund is investment vehicle where a lot of retail investors come in, and SEBI in its all heart and soul wants to primarily protect these kinds of investors, the small ticket size SIPs, retail guys. So SEBI has been quite actively taking a role in this part of the universe and trying to probably place things, or probably place, I won't call them restrictions, but regulations on mutual funds. So how do you view SEBI's active participation in this space? And the second part of the question is, what remains your advice to mutual fund investors? Because as you rightly said, that a lot of new investors are coming in, and sooner or later they're going to take the mutual fund route also. So you have got this huge influx, people, first timers coming to the market, getting new jobs, starting SIPs. So what will be your advice to them, and what is your view on SEBI's participation in this space overall? Over to you, Siddharth.
Yeah, I think SEBI's played a very positive and proactive role, and also at the same time been very responsive. So I think their move of the recent moves, I would think have been very commendable. Like one was obviously the classification. I think before that, if I was a layman investor myself, I think it was pretty confusing that within large cap or within mid, there was so much of variance between funds. So I think that was one great move, and also recently, the attempt they tried to do on on the multi-cap side, they were very responsive, and they took feedback very positively, and they were listening to the market. I think that's one key positive. So while whatever measure they took was with with the right intention of being helpful to investors, they were at the same time responsive enough to kind of listen to the market participants and try and evolve around those things. So I think they've been playing a very positive and constructive role, and so to that extent, that's one big advantage. And I think that is one of the reasons why when you look at the mutual fund industry, it's grown the way it has in the last 5-7 years. So you always need a watchdog, or you always need a regulator who's very effective, at the same time also able to kind of hear back from the market. So that's on point one. The other point you mentioned as to our advice on investors. So I think one thing that actually, if you ask me, what I have felt in the last 3-4 years is that the retail participants as such have evolved significantly in India. If you go back 5 years, 10 years, the way the retail investors used to behave is very different from the way they behave today. In fact, I find them a lot more because of the advent of internet, the advent of
So that we are losing voice in between. So I mean, I'll ask.
okay.
Can I request you to just
I
repeat the last line?
Yes. Yeah, no, so I was saying today, when I look at the investors today, I think they are very different from the retail investors in the past. They are not more informed. They are not more knowledgeable because, there is, they can access the internet sites, they can access reports. And to that extent, even the advisors have played a key role in educating them. Even SEBI has been playing a very proactive role. So I think the new millennium, the new generation of investors are very different, and I think these investors are very in that perspective, taking a long term view here, whether they are investing through insurance or whether they invest into mutual fund. So I think already we are seeing those benefits happening. The SIP book is a reflection of that. And I think the only advice would be that investors, if they take a longer term view in equities, I think it's been proven across time frame that on a long term basis, equities lead to to give best returns across asset classes. And I think that today's investors understand this very well because they realize that the biggest risk they face is inflation. And if they don't invest equities on a long term basis, they will not be able to kind of create the kind of wealth they need for their key requirement, whether it be education for their children or their post-retirement and so on. So I feel equities needs to be a core portfolio for all investors today as such.
Right. So thank you, Siddharth, for being with us on the call. I think I'll also take this opportunity to thank the listeners to tune in on the call today. I think it was a very exciting test match in the earlier half of the day and an equally interesting and insightful webinar on the second half. So thank you, Siddharth, for being with us. Thank you, listeners, for being with us. You can follow our our page on YouTube for more such videos. We hope to interact with you further, Siddharth, on many such occasions. All the best to you, and Merry Christmas and season greetings in advance to all of you. Thank you.
Same to you all, and thanks so much for sparing time and joining this webinar. Thanks again. Thanks everyone. Thanks, Sankalp.